Hello and welcome everyone to this Crisil session on Private Market Pulse Expert Perspective. I'm Abhik Pal, the Global Head of Buy-Side Research and Sustainability Practice for Crisil GRRS. I have with me Mark Berkeley, Global Head of Investment Management and Coalition Greenwich. Mark is based in London and consults with Coalition Greenwich's global investment management clients with particular focus on the UK and continental Europe. Welcome, Mark. Today we are here to discuss the key trends in the European private market space from an investor's perspective. Coalition Greenwich has recently published a report titled Private Markets, Opportunities and Challenges in a Changing World. This report offers valuable perspective from an asset allocator's point of view, with a specific focus on pension funds, both DB and DC, insurers, banks, sovereign and wealth funds, and other prominent institutional investors in the private asset space. We will predominantly focus on this particular report in our session today. With that, Mark, if I may kick things off, can you share with the listeners the objective and the methodology behind the 2023 Global Private Market Study?
Thanks, Avik, and it's great to be with you today. We at Coalition Greenwich conduct research so that asset managers can hear investors' views firsthand. We've got a significant focus on private markets. Private markets is, of course, a key area of focus right now for specialist private markets managers, as well as increasingly generalist investment managers, where their revenue from private markets can have a disproportionate impact on their overall profitability. This research focuses on institutional investors or asset owners and how their private markets practices and preferences are evolving in a much changed environment. We felt it was an important time to assess investors' views as input into asset managers' private markets strategies and tactics. So this research was conducted with 100 large institutional investors in Europe in the second half of 2023. We also conducted this research in North America and Asia. The research covered private equity, private debt, private infrastructure, both debt and equity, and private real estate debt and equity. Note that we conducted similar research in 2020, so we have trend history to compare the findings to.
That's great, Mark. Right, maybe getting into the meat of the report a little bit right now. The study highlights several key trends. One being a significant net increase in the target allocations in private equity, private infrastructure equity, and private debt. Can you shed some light on that?
Yeah, so we asked investors if their target allocations in each of the private markets asset classes noted had increased, decreased, or remained the same over the past 3 years. The findings indicated a significant number or percentage of investors who had increased allocations to private markets. The percentage of investors who increased their allocations was highest for private debt, 42%, for private equity, 43%, and up to 51% for private equity infrastructure. Now, about 10% of the investors told us that they had actually decreased allocations to these asset classes, with the remainder saying that their target allocations remained unchanged over the last 3 years. Now, digging into the findings a little bit more, a couple of things to note. One, the largest investors, and particularly those with assets of 10 billion or more, were even more likely to increase allocations. So across private debt, private equity, private infrastructure equity, the percentage who increased allocations there was actually over 50%. The other thing we noted was a real disparity between continental Europe and the UK. In continental Europe, we see rising allocations across private markets asset classes. UK, and following the financial crisis in late 2022, it's a different story. Liquidity is a key issue, particularly in the DB space. Many institutional investors have actually decreased allocations to private markets. In fact, in the UK, more investors told us that they had decreased private markets allocations as opposed to increasing allocations in the past 3 years. Now, what's driving these increased allocations? Well, certainly the attractiveness of the asset classes. In the research, we ask investors, what's the most important reason or reasons that you invest in private markets? And the top 2 reasons were rate of return and portfolio diversification. Now, one other thing I would highlight that we noticed over the 3 years and looking back to the research in 2020 was a notable jump in investors' understanding and expertise related to private markets. So in 2020, 7% of the investors said we have sufficient in-house resource and expertise to manage private markets without external assistance. In the current research, the figure was 27%. So that's up 4 times. Now, we know that investors in the UK rely heavily on investment consultants. Over 90% of the investors in the UK utilize a consultant, and they'll be involved in these decisions. The increased sufficiency and expertise came in continental Europe, where 34% of the investors now say that they have sufficient in-house resource and expertise to manage private markets without any external assistance.
Just moving a little bit on the report, right? There was also a clear indication of a preference towards commingled funds. Nearly 80% of the private market investors opted for this approach. Your thoughts on the popularity of this structure and the co-investment strategies observed amongst large funds?
Sure. So we asked the investors about their preferred structure for private markets investments. They could indicate a preference for more than one structure, and some did. As you note, about 80% said they prefer commingled funds, far and away the most popular structure, and preferred by investors of all sizes. About 20% that they have a preference for separate or segregated accounts. As with other asset classes, this was by and large larger investors. 24% said that cited co-investment in individual transactions. This was progressively more preferred as the size of the investor increased for larger investors. And 20% preferred direct investment in specific private assets. These were mostly investors with assets of 10 billion or more. So not surprisingly, larger investors have a significantly greater preference for co-investing alongside managers or making direct investments. Just to say, one other area we looked at and related to this was secondaries. About 40% of the investors in continental Europe and 17% in the UK said that they have used secondaries. Now, of those investors who haven't used or don't use secondaries, only about 5% said they expect to use or participate in them in the coming year. However, this is one to watch. We did some separate research recently conducted with investment consultants in the UK, and they indicated that they're looking much more closely at secondaries.
Interesting. Staying on the report, right? Another noteworthy point which came out was the duration preference of the investors, with 8 to 10 years coming out as the sweet spot for large funds. Any further nuance that you can share with the listeners on that?
Yeah, so I mean, as noted, investors said the most important reasons they invest in private markets is rate of return and portfolio diversification. Conversely, we asked them, what are the most important risk factors with regard to private markets investments? And the 2 top answers were lack of transparency and illiquidity concerns. So liquidity is certainly an issue. Now, we asked the investors about their preferred duration when making private markets investments. About 60% of the investors in continental Europe and about 60% of the large investors across the whole survey have a preferred fund duration of 8 to 10 years. So absolutely, this is clearly the sweet spot. But again, I would note that we saw some disparity between the UK and continental Europe. In the UK, 2/3 of the investors said they prefer a duration of 7 years or less. This would certainly include DB plans. Some of the investors who do have a longer term investment horizon in the UK would include endowments and foundations and local authorities. In continental Europe, in contrast, 80% of the investors said they prefer a duration of 8 years or more. So another clear difference. Now, while this 8 to 10 years is a sweet spot, important to note, it doesn't mean that investors won't invest for longer. So when we asked the investors what is the longest fund duration they would be willing to invest in, and despite 8 to 10 years being the sweet spot, over 60% are willing to invest in funds with a duration of 11 years or more, including 36 who would consider 15 years or more.
Brilliant. Moving forward, staying with the theme of covering the different parts of the report, The report also suggests a more pronounced manager change in the next 3 years. This was very interesting, this anticipated shift in manager roster. Could you further elaborate on that too?
Yeah, so there's a lot going on for asset managers in private markets, both in terms of new opportunities with prospects, as well as maintaining longer-term relationships with existing investors. We see a significant level of expected change in activity as investors increase or decrease allocations and make changes to their rosters. So a lot to play for. In terms of investors' expected change in allocation to private markets in the next 3 years, so looking forward, about 30 to 40% of the investors expect to increase allocations to private debt, private equity, and infrastructure, both debt and equity. Conversely, for private real estate debt and equity, only about 16% expect to increase their allocations. And in fact, about 1/3 expect to decrease allocations. So net a decrease in terms of private real estate. Now, in terms of the quantum of expected change to manager rosters over the next 3 years, and I think this is an important point, just over half of the investors expect to change the number of investors on their roster, either up or down. There's an expectation for a net increase in manager rosters for all asset classes other than real estate. So if we take, say, private debt, private real estate as examples, about 1/3 of the investors plan to increase their manager roster in these asset classes, and about 20% plan to decrease their manager roster. Now, one of the interesting questions that we asked in both 2020 and 2023 was if investors have a preference for specialist private markets managers or generalist managers who have both public and private capabilities. Now, in 2020, about 50% of the respondents said they preferred private market specialists. This year, the figure is down to 30%. So I would note a little bit of variation there by asset class. While the average who prefer a specialist manager is 30% this year, this preference ranges from a high of 39% for private equity to a low of 22% for private debt. Takeaway, I think, as generalist managers make more inroads in private markets, as investors' private markets knowledge and expertise continue to increase, it's clear that investors are prepared to consider a wider field of potential managers.
You touched upon real estate a little bit, right? So the report also touches upon the opportunistic strategies in real estate and the potential in alternative energy within infrastructure. But would you like to talk a little bit about that?
Yeah, so we asked which areas within both private real estate and private infrastructure offer the most attractive investment opportunities in the next 1 to 2 years. Now, for private real estate, there's a split in views as to the most attractive investment opportunities. About half, 48%, indicated that opportunistic strategies are most attractive. About 38% noted core plus, 23% value add. So a bit of a split there, and a few of the investors chose more than one. Now, for private infrastructure, much more clear-cut, overwhelming consensus. 82% of the investors cited alternative energy, clean technology, geothermal, solar, hydro, wind power, as offering the most attractive investment opportunities. This is, of course, against a backdrop where ESG and sustainability remain extremely important for institutional investors across Europe and show no sign of abating. In some separate ESG research that we conducted, over 90% of European institutional investors say that they employ ESG in their portfolios. Now, the comparable figure in the US is less than 50%. And on a related point, in the research that we just conducted on private markets, we asked investors if they have ESG requirements that are specific to private market investments. So ESG requirements that are specific to their private market investments. 43% said yes. This is up from 25% in 2020, so moving up. So ESG, and specifically within a private market context, has increasing importance, and certainly this has implications for asset managers.
Summing things up, Mark, maybe one last question. You mentioned at the beginning that you have also completed a similar research in North America and Asia, but staying with the North American trend, what are some of the big regional differences between North America and Europe?
Yeah, so we conducted research with institutional investors in North America at the same time as we did in Europe. And we spoke to just over 100 investors, about 3/4 in the US and 1/4 in Canada. And we saw a number of similar themes in North America. And let me just give you a few examples. One was target allocations. These have risen across the board in North America in recent years, most notably private equity and private debt, to a lesser extent real assets. Corporate plans have elevated their allocations, primarily in private equity and private debt. Publics and E&F have increased exposure to real assets. Now, in terms of preferred duration, we saw again a sweet spot, 8 to 10 years as the sweet spot for nearly half of the plans. So that was similar. Future allocations, again, investors project a net increase for private debt and private equity, somewhat more neutral on real estate. And in terms of manager rosters, we discussed that in the context of Europe. Investors in North America expect a broad increase in manager rosters, and most notably in private equity and private debt. One other area which was not covered quite as much in this, but it came up in some other research we did, is the democratization of private markets. So enabling retail investors access, including through their VC plans. This is a big issue in North America, also growing in Europe, particularly in the UK, where DC schemes are very prevalent. There's a significant focus on enabling investor access to private markets. So a number of similarities between North America and Europe, but let me just say a few of the differences. We did see some differences between North America and Europe. So one of them was on risk factors. In North America, illiquidity is clearly perceived to be the number one risk factor when it comes to private markets. But the number two is valuation and overcrowding concerns. So you may remember in Europe, actually lack of transparency was higher on the list. So this valuation and overcrowding concerns high up on the list in North America, possibly reflecting the maturity of the North American market. Another difference on fees. So one of the questions we asked in the research was if investors have paid above market fees to managers with the expectation of higher returns. In North America, 54% said yes. This figure was lower in Europe, it was about 38%. So somewhat of a difference on fees. And then finally, I would mention ESG. I had mentioned that we asked if investors have ESG requirements that are specific to private market investments, and that 43 said yes in Europe, up from 25%. Comparable figure in North America, 8%. So a big difference. And so while we see a number of similarities, there certainly are some differences when we look across the research between North America and Europe, with some important implications for managers operating in both North America and Europe.
Yeah, no, very good summary, but maybe a topic for a different podcast. With that, thank you, Mark. Thanks for your time and for sharing your expertise and insight. This was, I really enjoyed it. I'm sure our viewers would. And to our viewers and listeners, thank you very much for joining today. Stay tuned for more engaging content from Crisil going forward. Thank you.